Q3 earnings season has officially kicked off this past week with several of the biggest banks reporting, including JP Morgan Chase, Wells Fargo, and Citigroup. So in today's video, we'll be doing a quick recap of each one of them. We'll also take a look at what they had to say about the current state of the economy, which by the way was pretty negative. And because these are the biggest banks, I think anything they have to say about this, any insight they give, is definitely worth paying attention to. So we'll take a look at that. And then we'll finish up the video with me giving my overall opinion on bank stocks right now too. And I'll let you know which ones are my favorites and whether I'm investing in any of them. So it's going to be a fun one. I hope you guys enjoy this video. Hit that like button if you do, but let's not waste any time. Let's just go ahead and jump straight into this. All right, now first of all, I think this article here from the Wall Street Journal really sums it up best with the title reading, "Big Banks Say Trouble is Coming, but their earnings are still strong." So let's take a closer look at this. Well, here's the top 5 largest banks in America by assets, which by the way, just these top 5 alone make up over 50% of all bank assets in America. So they definitely have a ton of exposure to the economy. Now, Chase, Citigroup, and Wells Fargo all reported last Friday, while Bank of America and US Bancorp will report later this week too. So for now, let's just take a look here at the ones that have already reported, and we'll just start with the largest here in JP Morgan Chase, ticker symbol JPM, who really had a beast of an earnings report, not only beating on both the top and bottom line, but check this out, guys. They grew sales by a whopping 22%, net income profits by a massive 35%, and they grew even more on earnings per share by almost 40%, which was boosted by the billions in stock that they've been buying back this year. But yeah, those growth rates are really just insane for the biggest bank to still be growing like this. It's really crazy to watch. Which, by the way, JP Morgan admitted to themselves, saying that this type of growth is not very ordinary for them and will probably correct back down eventually. And I agree with that myself, as it was largely fueled by 2 specific tailwinds right now, those being the recent takeover of First Republic Bank, which was one of the recent bank failures this year, and the other tailwind being the giant elephant in the room, which is our really high interest rates that still sit higher today than even right before the Great Recession, which helped them generate much more net interest income, which surged 30% in the quarter, while their retail banking division also popped another 36% as well for the same 2 reasons. However, corporate and investment bank services actually declined by 12% due to trading and advisory sales falling, which does make some sense considering all the fear going around about the economy and the markets, which I'll touch on here in just a second. And even JPM stock itself only climbed by less than 2% on Friday after reporting what, again, I felt was pretty amazing results. And in my opinion, this likely had a lot to do with the post-earnings comments from CEO Jamie Dimon, that were pretty negative about the economy, calling this possibly the most dangerous time the world has seen in decades, warning that the wars and conflicts involving Ukraine, Russia, Israel, and Palestine may have far-reaching impacts on energy and food markets, global trade, and geopolitical relationships. Also saying that in addition to the military conflicts, he's concerned about the persistently tight labor market and extremely high government debt levels, including the largest peacetime fiscal deficit ever, which he warned are increasing the risks of both inflation and interest rates remaining high. And yeah, those are all points that I largely agree with myself too. Like, for example, he talked about this being the largest peacetime deficit. Well, we literally spent more money on the pandemic than we did on all of World War II. How crazy is that? So obviously we were going to be left with devastating inflation, which is still lingering at one of the highest levels in decades, and that's even after it's already fallen by a huge amount because of all the recent rate hikes. But again, even here we're still very high, and actually in June, inflation surprisingly started to rise again, climbing from 3% in June up to 3.2% in July, up to 3.7% in August, and then we just received September numbers this past week, and it stayed right there again at 3.7%, staying elevated, which all of that is pretty crazy. It's pretty concerning, I would say, considering that we've already raised rates 11 times in a row at literally the fastest pace of tightening since the 1980s. And by the way, we also just had Fed officials say that there will likely be yet another rate hike at some point this year, and that rates will remain higher for longer than previously expected. So that's also concerning. And so that's why Diamond is really so worried, even when his bank is performing pretty well, adding that currently US consumers and businesses generally remain healthy, but consumers are spending down their excess cash buffers. So while Chase is hoping for the best, they are actively preparing for any scenario. And I think I can translate that to basically saying that companies are doing fine for now because of the higher spending, and consumers too. And even banks are having great results because of the higher interest income. But as soon as consumers start running out of their cash reserves, out of their money, well, that's going to cause defaults on loans. You're going to see overall spending go down. The economy could spiral into a recession, and all of these companies, and especially banks, will eventually suffer. So I think that's what they're kind of preparing for too. And to me, just kind of watching all of this, watching the economy, I feel like we're seeing someone trying to cross like a frozen lake here, and we're all just wondering if they'll make it to the other side safely in what would be referred to as sort of a soft landing, or if that ice is going to crack and break and they fall through, giving us a recession and, a major downturn. And I just think the longer that this goes on, the more that interest rates remain high, it's like that ice just keeps getting thinner and thinner and thinner as as they walk along it. I have said this before though, and I will say this again, I'm personally just not as worried about a recession as most other people are. Really, if we didn't have high interest rates, then I'd be more worried about it. But because we have them so high already, I just know that the Fed will be able to lower them at the first sign of a recession, and that should boost the economy, send it soaring with the market right along with it, and it'll just have a quick recovery, in my opinion, relatively quick. And so any kind of market crash or recession would ultimately just be a buying opportunity for me, something to just really go heavy on during that time, and then ride up the wave right after. Now, of course, I could be wrong about a lot of this, and especially given all the global conflicts going on right now, that's a real wild card that could cause a lot of destruction, send things out of whack. And it's really just a heartbreaking, very sad situation going on too. I feel kind of weird talking about money when so many people are suffering. Of course, my thoughts and prayers always go out to them. But this is my job to continue making these videos about the stock market and the economy, regardless of the really sad and unfortunate things that always tend to happen around the world. But anyway, don't mean to bring down the mood here, but just when it comes to stocks specifically, what I'm trying to say is that I just don't really think that it's necessarily time to panic yet. But it is something that we have to just kind of keep watching closely. And ultimately, I still think that a long-term strategy will serve me best. So that's what I'm going to be sticking with myself. Now, having said that, let's go ahead and finish up with earnings from Citigroup and Wells Fargo, see what they had to say. Spoiler alert, they also had some very negative comments about the economy, but we'll take a look at that, and then we will finish up with which bank stocks are the most attractive in my opinion. All right, well, believe it or not, Wells Fargo actually saw the biggest gains on Friday, rising over 3%. They're usually one of the least favorite banks out there because of all the controversies and the bad performance that they've had in recent years, but not this time, as they beat analyst expectations. And while they didn't get anywhere close to the same revenue pop as JP Morgan, only growing sales by less than 7% year over year, their net income did skyrocket by more than 60%. However, unlike JP Morgan, Wells Fargo didn't actually benefit too much from net interest income, as that only rose by 8%, and even non-interest income only rose by 4% as well. Instead, the surge in profits was largely due to an easy comparing year because of some charges that they had the year prior, while also cutting expenses this time and restructuring parts of their business, which was partly in preparation for a slowdown in the economy. As the CEO also noted that while the economy has continued to be resilient, they are still seeing the impact of the slowing economy, with loan balances declining and charge-offs continuing to deteriorate modestly, which is definitely not a good sign. Those are concerning comments. And then when looking at Citigroup, they actually saw the worst performance of all, as they initially climbed on Friday but then fell right back down later in the day to still finish slightly in the red, as they were able to beat analyst expectations, but both sales and profits only rose by a single-digit percent, while EPS was about flat year over year. So definitely not as much growth as the other two big banks, and I think Wall Street kind of punished them for that. And just like the other two, Citigroup also issued several warnings about the economy, with the CEO basically saying on the earnings call that the global macro backdrop remains volatile and desynchronized, as recent data would imply a soft landing, but history suggests otherwise, and they are already seeing cracks in the lower credit score consumers. And by the way, she also noted that Europe is looking even worse too. So really just a lot of negativity coming from the big banks so far. And again, that's despite the fact that they actually had some pretty good earnings, especially in the case of Chase. I thought their earnings were fantastic. But going into next week, I think we'll probably see a similar situation here. Bank of America reporting, that's the second largest bank. I think they'll probably show up with some decent results. Bancorp, the smallest of the bunch, smallest of the big five, I think that's a little bit harder to predict. I could honestly see that one going either way. It's a bit of a toss-up. I could easily see them surprising and maybe popping up a bit like Wells Fargo did, but I could also see them maybe showing up with some lackluster results that just don't impress as much as the other banks, and maybe Wall Street punishes it for it, and maybe it declines a little just like Citigroup did. So I feel like it could kind of go either way, but overall, probably just going to continue seeing some pretty good performance here from at least the biggest banks. And it's all just kind of the same story here with all of them. Good enough results, but a lot of warnings about the economy and them just not really being sure if we will have a soft landing coming out of all of these economic issues, or if we will have an actual recession soon. But I think that makes this as good a time as any to finish up with my thoughts on these individual stocks and which ones I prefer owning myself. Well, I already own Chase and US Bancorp. Now Chase, I haven't purchased in a while because I had already built it up to the position that I wanted in the past. But US Bancorp is actually one of my newest stocks. I started buying it this year, and so it's a relatively smaller position that I have been adding to over time. And for me, I just feel like these two stocks really give me a good balance of stability and value in the banking sector. Now, Chase, I just think will never fail. They're so large, so well run. So I really have them for that stability and kind of reliability long term. And then US Bancorp is more of the beaten down kind of value dividend play that is higher risk, but could potentially have higher reward potential too. And I'll just quickly show you some stats here on why I think all of this and how these stocks compare. Well, like I mentioned earlier, Chase is clearly the largest by assets. They're, in my opinion, the most reliable, most stable of all the banks. And that's even being shown right now, already taking over failed banks, just like they did during the financial crisis and Great Recession of '08. While US Bancorp is, of course, the smallest of the big five, but again, I'll show you why that's more of a value play in just a second. When looking at how well run these banks are, though, the two most popular profitability metrics for banks are really return on equity and return on assets. And right away, you can see that Chase is just by far the best run of the bunch when it comes to return on equity, with the others being, pretty far behind. And actually, USB is pretty good here too, only in second place by this metric. The story is also about the same for return on assets, with JPM clearly being in the lead once again, while USB is almost tied with Bank of America and Wells Fargo for that number 2 spot as well. Now, when we turn over to the actual stock valuations, well, we see that Chase has only fallen by 15% from the top because of that superior performance, while Citigroup and US Bancorp saw the biggest declines, losing half their value each. That does, however, leave them with the cheapest valuations by a forward PE ratio, though, while Chase is clearly the most expensive. But again, you get what you pay for with Chase, and that's very high quality. So I take Chase for that quality, but I also take USB for the value and the dividend, which when you look at dividend yields, USB is well ahead of the pack at a whopping 6% yield. And by the way, they also have the biggest growth history too at 12 consecutive years as well. And this is also one of the highest yields that I think I've ever really seen in the stock too, so that's very attractive. Which in my opinion, I just think this is too cheap of a price here for US bank stock, and I think over time, over the longer term, I think the stock will have to kind of go back up to rebalance that a bit. Now, I'm not saying that it can't go lower in the short term. Again, all of these banks have been essentially warning of a possible recession, which could definitely drag these stocks much lower. But that's why I think that it's smart to kind of limit the exposure to them for now, at least. And that's why I only hold around 3% of my portfolio in Chase, which I've purchased in the past. And then I still just have less than 1% in US Bancorp because I just recently started buying it. So it's still a very small position. And I think that's where I'm kind of comfortable for now. Maybe adding a little bit to US Bancorp depending on how volatile it is here in the short term. But overall, I'm still very optimistic over the long term. Even if a recession hits, again, I just think lower prices are coming, buying opportunities. And who knows, maybe we don't even get a recession. Maybe we get a soft landing and a recession doesn't hit for another, couple years or whatever, and a crash doesn't come right away, then some of these stocks could still perform relatively well, even in the kind of medium term. And all the meanwhile, I've been able to collect some great dividends. With Chase, I've been collecting dividends for years, and US Bancorp, I just started collecting dividends, and it's a very high yielder, so I'm appreciating collecting those all in the meantime as well. But anyway, those are my thoughts on all of this. I'd love to hear what you all have to say down below. Do you own any of these stocks like me, or are you just staying completely out of the banking sector, too worried about it? I'd love to hear your thoughts. Drop them down below. We can have a conversation. But thank you so much for stopping by, my friends. I hope you enjoyed the video, and I will catch you in the next one. Take care, everybody. Bye-bye.